structure is a very important thing to begin with. And I've always been kind of enamored by corporate law as a general rule. But there's two things. As an advocate for our investors, finding just hidden fees and we see this is prevalent throughout, so much of the banking business, so much of the investment business. And we wanted to, like I said, we wanted to be in the performance business more than anything. So when I first started looking through the documents, you start to see acquisition fee, disposition fee, paying some broker dealer for acquiring the capital, and then a management fee, and then expense reimbursements. And when you started to look through it, so many of these documents have 10, 15% fee loads. So if someone's putting in $1 million, they're walking, in the door with $850,000. So the $850,000 that's being invested, and you're garnering a 7% preferred return or an 8% preferred return at the time, makes it really hard for the investor to make money, where the managers or the sponsors are rewarded for capital raising. So that was the first big thing that stood out to me, is that this is a capital raise. This is a sales business on its face. And then you talk about getting an 80-20, or whatever, a 2 and a 20, however hedge funds call it or private equity firms call it, meaning 20% of the profits after money's returned to clients. Well, that 20%, starts to become a much bigger number when you factor in the fee loads. So one of the first points structurally was us moving the documents away from being rewarded for capital raising. What that did is made us more stringent on the deals we were looking at. And so the more that we're able to look at the deals, and I'm not running a charity here. Like we want to have and you talk about alignment of interests and this jargon that's thrown around. But what's more aligned when it's my kid's fucking money, my money, and I'm not being rewarded just for raising capital? So I'll share the deal with you, but just because you put money in doesn't make me any money. Are there expenses to be paid? And yes, that's the business. But one thing is, getting commissions and things of that nature, which we've never done before. And those were the core takeaways. And being an attorney and being a fiduciary by nature, because broker dealers are not fiduciaries. That's just a misnomer of the word. Wealth managers and registered investment advisors are fiduciaries. They have a static fee on assets under management. As the assets grow, their fee increases. Whatever, attorneys are fiduciaries. And I've been advised by every attorney that I've ever had to table my license. And I looked at it over the years, and I found, being in the rooms with some of the smartest investors in the world, they like it. They like that actually I'm an attorney, and that, am I their attorney per se? No. But the heightened fiduciary duty of being a licensed attorney and dealing with these documents and understanding them. And it wasn't, there's a lot to be learned. I mean, some of these documents are 300-400 pages long, but having some of the best attorneys in the world at DLA Piper, at Greenberg Traurig, working with the top auditors, using our third-party admins, and we learned a lot about investor protections. And the documents and the deals don't guarantee you make money. I mean, you can go get hit by a bus. You learn that from your doctor investors very quickly, that nothing is guaranteed in life, but you can increase the probability of success. Certainly from a management standpoint, is if you're not incentivize yourself on the front end just for raising capital. And that was one of the first things that we built, this internal safeguard of saying, okay, does that mean the deal is going to make money for sure? No. But it does mean that we're going to sharpen our pencils and not necessarily spend our time on diligence, using our human capital to underwrite the deal and go out and talk to clients, if we didn't have a high degree of certainty that the deal was going to pencil even better than we thought, and sticking to the old mantra of kind of under promising and over delivering.